The secret of Marwadi investment. Those boring rules that build wealth for generations. It's 2 meters. The stock market is about to open the next day. On TV channels, headlines like big opportunity and multi-bagger alert are flashing. A new stock is going viral in WhatsApp groups. But in an old Haveli-style house somewhere in Rajasthan, a trader is sleeping peacefully. There has been no dramatic change in his portfolio. He hasn't made a single trade today. He hasn't sold anything in panic, nor bought anything in excitement. And the strange thing is, 20 years later, that same man will have won the financial race. The question is, are there really different principles behind Marwadi investment? And if there are, why are they so quietly effective? Go to any corner of India. Old markets of Kolkata, wholesale bazaars of Assam, textile hubs of Chennai, trading lines of Hyderabad, commodity mandis of Mumbai, or border towns of Nepal. You will find Marwadi businessmen everywhere. It is said that when they migrated from Rajasthan, they left with just a lota dori. Today, they are at the top of many industries. This is not a story of overnight success. This is a story of disciplined accumulation. And financial experts like 𝐮𝐻𝐿𝐴 explain that behind this are some clear financial habits that look simple but have deep impact. The first and strongest principle is protection of capital. An average investor runs after returns. But the first question in the Marwadi mindset is, what if everything goes wrong? They think about survival before profit. They consider the emergency fund sacred. Business money and personal expenses are completely separate. Only the leftover money takes risk. This approach doesn't come from fear, it comes from mathematics. The psychological pain of loss is greater than the joy of profit. So they know that if capital survives, the game continues. If capital is finished, the story ends. The second quality is emotional distance from assets. An average investor gets attached to a stock. He says, this company is the future. He keeps holding a falling stock because he likes the story. But the Marwadi approach is simple. What is the return on capital? If the numbers are bad, exit. No ego, no social media debate. They are not influenced by brand names or hype. Their loyalty is to profit, not sentiment. This unemotional clarity protects them from losses. The third principle is, holding cash is not laziness, it is strategy. In today's digital investment culture, we are taught that all money should be invested. But a Marwadi investor is comfortable keeping 15 to 25% of the corpus in cash. This is not hesitation, it is ammunition. During a market crash, cash becomes opportunity. In the 2008 financial crisis, in the 2020 pandemic crash, those who had liquidity bought assets at a discount. Cash also gives a psychological cushion. It prevents panic selling. The fourth quality is, slow money is better than fast money. Compounding is boring but powerful. If you consistently earn 12% annual return for 25 to 30 years, wealth grows exponentially. Warren Buffett has also called compounding magic. In the beginning, growth feels slow, but later the curve becomes steep. The Marwadi mindset prefers steady growth over getting rich quickly. They choose 15% consistent growth over 2x overnight. Because they know sustainability is more important than speed. The fifth habit is, focus on cash flow in real estate. While buying property, they don't look only at appreciation. The question is, how much rent will it give? And can I hold it for 10 to 15 years? Avoiding leverage speculation is their way. A cash flow positive property survives even in an economic downturn. That's why many Marwadi families own income-generating properties in prime markets, which give stable income for generations. The sixth quality is control over lifestyle inflation. If income increases, lifestyle doesn't have to increase immediately. First, strengthen the balance sheet. Create debt-free income streams. Then luxury. Many times, you will see even big Marwadi businessmen maintaining a simple lifestyle. This is not image management, it is philosophy. Financial shocks often come not from low income, but from uncontrolled expenses. That's why show-off rarely happens before wealth is built. The seventh and perhaps most underrated quality is making wealth boring. The portfolio is not shuffled frequently. There is no trading excitement. There is systematic discipline. There is process instead of emotional impulse. There is regular review, not impulsive reaction. For them, wealth building is not entertainment, it is engineering. And in engineering, there is less excitement and more precision. If we look at historical context, the Marwadi community has worked for centuries in trade, lending, and commodity markets. Risk assessment has been part of their cultural training. The importance of hisab and lekha is taught from childhood. In family businesses, the next generation grows up watching accounting books. Cash flow, credit cycle, inventory management. These concepts are not theoretical for them, they are practical. Another subtle factor is community network. Marwadi business networks are strong. Trust-based lending, informal information flow, risk sharing. All these increase capital efficiency. Sometimes community support helps absorb losses. But community pressure also enforces discipline. Reputation is a critical asset. That's why reckless behavior is rare. Now the question arises, Is this model relevant in today's digital era? The answer is yes, perhaps more than ever. Amid fintech apps, instant trading, crypto hype, meme stocks, patience has become rare. But the fundamental rule of markets has not changed. Capital preservation, cash flow, compounding, disciplined allocation. These are timeless principles. Behavioral finance also says that humans are driven by loss aversion. Emotional decisions cause damage. Systematic rules reduce emotional bias. The Marwadi model is essentially a model of behavioral control. A process-driven approach replaces impulse. It is also true that not every Marwadi investor is perfect. There are risk takers and aggressive traders within the community too. But those who build generational wealth often show these 7 traits: discipline, patience, liquidity, emotional detachment, steady growth focus, asset-based thinking, and controlled lifestyle. Experts like 𝐮𝐻𝐿𝐴 highlight these habits because they are not flashy. They are not viral. They don't look glamorous on an Instagram reel. But after 30 to 40 years, the result becomes glamorous. Think of a practical example. If someone invests 5 lakh at the age of 25 and earns 12% compound growth every year, after 30 years it can become more than 1.5 crore. If the same person keeps investing incrementally every year, the corpus can multiply many times. But this will only happen if panic selling, over-leveraging, and lifestyle overspending are avoided. The Marwadi approach does not avoid risk, it calculates risk. They expand business too, but keep debt manageable. Diversification is limited but strategic. Over-diversification creates confusion. Under-diversification increases risk. Balance is key. And perhaps the most interesting thing is that wealth for them is not the end goal. It is a stability tool. Stability educates the next generation, expands business, and makes philanthropy possible. That's why wealth creation is a marathon, not a sprint. Now imagine that same 2 meters investor who doesn't get carried away by TV hype, deploying cash in the next market crash. In the next decade, the portfolio doubles. Meanwhile, the hype-following investor remains stuck in a buy-high-sell-low cycle. The difference is not dramatic, it is gradual. But in the long term, it is decisive. So are the principles of Marwadi investment unique? Maybe not. Capital preservation, compounding, liquidity. These are universal rules. The difference lies in mindset. The community has practiced them for generations. They have turned discipline into culture. And perhaps that is the biggest lesson. Wealth is not glamorous, it is disciplined. Success is not loud, it is consistent. If you choose steady gain over quick win, the result may look boring, but the balance sheet will be exciting.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources: news from various news agencies, opinion polls, and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.